The Andrews Pitchfork indicator, commonly referred to as median lines, is one of the most versatile trading tools available. Andrews Pitchfork consists of a median line at the center and two parallel equidistant trend lines, where the outside trend lines represent areas of support and resistance. Traders often look for buying or selling opportunities as the price approaches the ends of these channels. In this chart, for example, the price remains largely within the bounds of the indicator, with the exception of several short false breakouts. The Andrews Pitchfork works in any time frame. This of course can range from tick charts to monthly time frame. This allows the indicator to work well for day trading and for long-term investing. The indicator can also work on any security. So whether you like to trade forex, futures or stocks, you can incorporate this versatile tool in your analysis. The Andrews Pitchfork indicator is created by selecting 3 points on a chart. A beginning point that represents the start of a trend, we'll call this point A, a reaction high coming after the beginning point, point B, and the reaction low coming after the beginning point, point C. The selection of these points is somewhat subjective, but it's a good idea to experiment with different reaction highs and lows to find what works best. In some cases, you may want to plot multiple Andrews Pitchforks on the same chart to provide an indication of where support or resistance may be the strongest. You may also look at different time frames to determine long-term and short-term support and resistance levels for a given security. You need to identify the right points in your analysis, because the success or failure of finding signals depends largely on how you plot the median lines. In most cases, drawing the median lines is rather subjective, but with practice you can develop the confidence required. A rather simple method is, after the pivot points are identified, tweak the median lines to encapsulate price action with the greatest level of accuracy. If you master how to use Andrews Pitchfork, you will have a competitive advantage ahead of the market because you will know the dynamic support or resistance levels in advance. Now, not all the trend lines that make the Andrews Pitchfork react the same. They offer different levels of support and resistance. The Andrews Pitchfork indicator has 3 lines. Each line starts from the pivot. We have the median line, the upper median line, and the lower median line. But they don't have the same importance. By far, the most important one is the median line. It has one big advantage. It attracts price. As such, it acts like a magnet. Because of that, traders use it to adjust their trading strategies. There are many ways to use this powerful trading tool. Some traders use it as a single indicator. Others integrate the Pitchfork with other trading tools. In any case, there's not one Andrews Pitchfork strategy that works all the time. The classical way to use this trading tool is to look after support and resistance levels. As you know, when we analyze a price chart, we can find classic and dynamic support and resistance levels. With this tool, however, the dynamic ones are more valuable. The bigger the time frame, the more powerful the reaction from the levels will be. The idea is to integrate the dynamic support and resistance rules with Andrews Pitchfork power. Pay attention at this example. The 3 pivots A, B, and C give the angle and the shape of the Andrews Pitchfork. The resulting lines act as future dynamic support and resistance levels. As always, once a level gets broken, resistance turns into support, and the other way around. Judging by the current prices, the outlook looks bullish. The key here is the median line. Many traders misinterpret how to use Andrews Pitchfork median line. While it attracts the price, it doesn't offer any support, nor resistance. Just the fact that it pierces it is enough for a strong trend. Strong trends see the median line guiding the price action. Eventually, the price will pierce it multiple times. As a rule of thumb, while the price stays within Andrews Pitchfork lines, the trend will keep going. The fact that it pierced the median line multiple times shows strength, hence you must not use it as a support or resistance. Here is another example to make it very clear. We identified the A point as the start of the move. Next, the B point is the end of the first drop. Finally, the C point is the end of the first swing higher. Even if the price gets above the upper median line, the bearishness is overwhelming. On top of it, the median line attracts the price on a constant basis. Furthermore, the upper median line and the lower median line act as strong support and resistance levels. Using Andrew's pitchfork this way gives dynamic support and resistance levels, but this is valid only for the upper and the lower median lines. For the median line, multiple piercings simply show how strong the trend is. In this case, very strong. However, how do we know when the trend ends? When should bulls consider a bottom is in place? The way to answer these two questions is to use the shift line. Few traders know about the shift line's existence. This is a line that connects the A point and C point. As such, traders know in advance when the shift line is. In strong trends, the price has a strong tendency to move away from it. As a rule of thumb, a bearish trend keeps going as long as the price stays below the shift line. Of course, the opposite happens in a bullish trend. Here's the shift line on the previous chart. It shows where the bearish trend ended. In fact, it shows where bears should not consider selling anymore. Because the shift line gets broken, it means bulls will step in on any future pullbacks. Now, based on the median lines and the shift line, the two most common strategies falling under the support and resistance umbrella include: first, buying or selling the bounce. Traders may buy when prices hit the bottom of a channel, but only in an uptrend, and sell when the prices hit the top of the channel, only in a downtrend. In these cases, it's important to wait for confirmation that the price is responding to these levels. Here are several examples of buying or selling the bounce. The second strategy involves buying or selling the break. Traders may buy when the price produces a breakout from the top of a channel, or sell when prices breaks from the bottom of the channel. In these cases, it's important to look for a clean break to avoid false breakouts. My favorite way to use the Andrew's pitchfork is to look for divergences between the pitchfork and the RSI. If you followed my channel, you know that I consider the divergence one of the most powerful leading signals you could get. So I look to buy or sell the breakout from the pitchfork only when I see a divergence on the RSI. This is powerful stuff, and let me demonstrate it. In this first example, you can see how the bearish divergence was formed with price making a higher high, while the relative strength index was seen making a lower high. The price eventually broke down through the lower median line, following the price failure. In the next example, you can see that the prices posted a lower low, but the RSI signaled a higher high, which indicated a bullish divergence in price. This leading signal suggested that the price would be reversing upward shortly. Following the breakout from the upper median line, we can see that a long position resulted in a profit as the price continued to push higher. I strongly encourage you to search for this pattern on your charts. Here are other trades based on RSI divergences and Andrew's pitchfork breakouts. Andrew's pitchfork is a great price action indicator to use when determining areas of support or resistance. While it's not perfect in every scenario, the indicator provides a good indication of where prices may be headed. The downside is that picking the main 3 points is a largely subjective process that requires experience to master. Here's one last important tip. A great way to use this tool is to perform a top-down analysis, meaning to study all timeframes. Start with the biggest one, the monthly timeframe, and continue with the weekly chart, the daily, and the 4-hour one. A multi-timeframe analysis with Andrew's Pitchfork will result in a better understanding of market conditions. If you got any value from this and learned something new, don't forget to subscribe, click the bell icon to enable notifications for new uploads, and leave us a like to show your support. Until next time.